All right, welcome to the last Money Club Mondays of 2021. We will be taking next week off. So today's December 20th. We'll take next week off, and then we will be ready to rock and roll in 2022 with Better Than Everything. So Merry Christmas to everybody. Happy holidays. Today, I just wanted to end the year saying thank you to everybody that's been part of this, that's joined the Private Money Club, been part of Money School, Money Multiplier, and following along with all the training and everything that we've been doing. It's because of you guys that we hop on here every week and continue to put out new stuff. So, with the end of the year, I'd love to hear what everybody's up to, what everybody's planning for 2022. So in the chat box, if you have anything you wanted to talk about, just put it in there and we'll be sure to bring it up here. Otherwise, I wanted to today dig into retirement accounts in a little bit more detail. It seems that IRAs, 401ks, I'm getting more and more questions these days about what's the right amount of money to put into them. Should I continue to contribute to a 401k? What are my alternatives? A lot of talk like that going on. So just wanted to get into a little bit about retirement accounts, a little more detail with them. And then, some of the changes that are happening in 2022 with the numbers. It doesn't seem like there's a whole lot of changes, but just wanted to kind of go through some of the stuff that's going on in 2022 and go from there. So if you have any questions regarding IRAs, 401ks, and the such, today is the day. All right, Mary, absolutely. Logging in live. Hey, Heather. Yes, Merry Christmas to all. All right. So with that being said, if you have a 401k at work, an active 401k, type in 401 or 401k in the chat box. I'm just curious if you have an active one. And then if you have an IRA, which is an individual retirement account, type in IRA if you have an IRA, one of the two. All right, so I'm going to draw a couple of things just to keep everybody on the same page here. So we have all right, so basically when we're talking about retirement accounts, these are simply tax advantaged vehicles that the IRS lays out the rules and regulations on how they operate. And the idea of a retirement account, whether it's employer sponsored or whether it's an individual retirement account, depends on your situation and how you're contributing to it. But basically, the rules for them are broken out in those two different types of areas. And we're going to talk a little bit about that, the pros and cons, and how that looks. So yeah, so thanks for putting that in. A lot of you looks like you have both 401s and IRAs. Kevin's got a solo K going, and a Roth self-directed. So that's pretty awesome. So we'll talk about that a little bit, traditional Roths, self-directed or not, what the difference is, what the options are. So we'll definitely get into this. Trying to figure out how I should do with multiple accounts. Also sign up. Yeah, Heather, if you're going to attend the Money School Essentials in January, the 22nd, 23rd, and 24th, we'll definitely get deep into all that stuff with you during that 3-day. So if you have any of these kinds of accounts, retirement accounts, if you have money sitting around, you don't know what to do with the stock market right now at the levels that it's out. Today we're seeing, last I looked, it was down like 500-600 points today. And a lot of excuses for what's going on, whether it's Omicron, whether it's the Build Back Better getting turned down 616 as I do this right now. So we're going to see a lot of these days, a lot of ups and downs and things happening, especially coming into 2022. So you got to be ready and know what you're doing, because if you're somebody that's close to retirement age right now and you're relying on that retirement account to pay your income for retirement, well, if you have $1 million set aside and the market takes a quick dump down, you could drop, your million could turn into 500,000 just like that. It happened to a lot of people in 08. It happened to a lot of people in the dot-com bubble. So we don't want that to happen to you in 2022, 2023, or whenever it happens. So let's talk about it. All right. So employer sponsored plans. These are things like 401k, 457B. You have your TSP, which is your thrift savings plan, which is typically a federal a federally sponsored, federal government sponsored plan. What's the other one? 403. It's 403B. So these are all employer sponsored plans. So what that means is employer you. So what happens with these sponsored plans is basically whenever you go get a job, and I'll never forget this. So let me just tell you guys this story. It's kind of what made me start thinking about this because, you know, I've always kind of been a contrarian, I guess, so to say, in my life. Like I've always looked at things in a different manner, a different angle, so to say. But I remember one of the first jobs I had, it might've been the first job I ever had that offered me a 401k, but I was just out of college. I was in my young 20s. I didn't know anything about investing. I knew nothing about the stock market, nothing about retirement accounts. That stuff's typically speaking is either not taught to you in traditional high school and college education, or we think in such a way in those grades that we don't pay attention to it, right? When you're young, it's hard to really imagine your life in your 60s when you're retired. So having to want to plan for some of that and like devote money to that purpose when you're 20 years old is kind of bizarre in its own right, right? So, but I remember, I was thinking about this over the weekend. I remember going to this job. I just got hired. I was super pumped. I just moved to South Florida, moved back to South Florida. I was born in South Florida, but I grew up in Southwest Virginia. So I just moved back down to Southwest for Florida over in the Cape Coral, Fort Myers area, if you guys are familiar with that. And I went and I got a job at a car dealership. Okay. So it was a Lincoln dealer. They sold Lincolns and we sold Mercuries. And I didn't know anything about car sales, but I had helped my dad a little bit through high school and college. He had a little used car dealership. So I knew a little bit about the car business. I knew a little bit about, you know, people and sales, and I like people. So I always knew I wanted to do something around that. And at the time out of college, I just moved. I didn't know what I wanted my career to be. So I said, let me just get a job, making some money, having some fun, and living life in my early 20s, right? So I got a job at this Lincoln dealership, and I remember signing the paperwork, and I remember the HR department, and one of the questions was, you know, hey, we have this 401k that we offer as a benefit to all of our employees. Do you want to contribute to this 401k? And I remember thinking to myself, okay, well, let me just ask you, like, what is a 401k? I don't know. And they said, well, it's a retirement vehicle. You can put money in, and you know, it'll grow over time. And then whenever you get to retirement age, you can start to pull the money out and you can live on it for retirement for your income. I'm like, all right. So I'm in my early 20s though. I'm, you know, having a lot of fun. I'm partying a lot. I'm going out. I'm spending money. I just bought a new car. You know, I'm in the process of buying a house right now with my cousin, who we did buy a house together with. And so, you know, I had all this money that I was spending, and I was like, I just want to make money and spend money. I don't really care about saving, but, you know, do most people do this? And they're like, yeah, you know, it's one of the benefits. Most everybody puts their money into 401k. And I'm like, all right, well, how does it work? Like, how much money do I put in? And they were like, well, if you put in, you know, you can put in pretty much as you want up to whatever it was, 10% or, you know, whatever they say. They said, you know, we recommend you put in, you know, let's say, I think it was 6%. This was 20 years ago. I barely, you know, almost 20 years ago. I barely remember, but so I think they were like, you could put in 6%, and they're like, and part of the benefits that you get with working and having this job is if you do put in 6% of your paycheck, we're going to put in another 6% to match it. And I said, okay, so you're going to give me money. If I put money in, you're going to match it and my money's going to grow that much more. And they're like, yes, except unless you leave the job within a year or 2 or 3, then you don't get all the money that we're giving you. We're going to take some back because you have to vet into it. So you have to stay with us for a long time before we'll give you all of that, but technically we'll give it to you. So, okay. All right. So you just take it right out of my paycheck, or I, you know, write you a check to put the 6% in, or how does that work? And they say, well, yeah, I mean, you're never actually going to get the money. So before you pay taxes on it, before it comes into your bank account, before we actually give it to you, we're just taking it from you. Okay. And then where does it go? And they say, well, you know, you can pick where you want to invest it, and then it'll grow over time, and then you can use it in retirement. Okay. So what can I invest in? Like, you know, I'm getting ready to buy a home right now. Can I use it for that? Well, no, you can't use it for your own home. All right. Well, you know, what if I bought a house and rented it to somebody else? Can I do that? No, you can't do that. Okay, well, listen, I love cars, right? I'm selling Lincolns. I've always loved Ford Mustangs. Can I buy stock in Ford? Like, I love the company Ford. I want to buy stock Ford with this money that I'm investing. Can I do that? Well, no. Ford might be in one of the little funds that you are able to choose from, but you can't directly buy Ford or sell it whenever you want. Okay, so it sounds to me like I'm giving you complete control of my, well, no. You get to pick which funds. Okay, well, what are in these funds? Well, a bunch of random stocks and bonds or cash, right? So it really limits your options. So I'm thinking to myself, all right, so I'm opening this account. You guys are going to take money from my paycheck before I ever see it. I never even touch it. You guys just take it from me. You're letting me invest it how I want, but only into these certain funds that you're giving me an option to invest in. All right. But the good news is it's pre-tax money. So you're not going to be taxed on it. Awesome. I don't want to pay more in taxes. I want to pay as little taxes as possible. But when you do pull the money out of the 401k in 40 years from now, when you retire, we're going to tax you on it then. So I'm thinking to myself, all right, well, I'm pretty young and I don't know a lot about taxes, but there seems to be a lot of news about taxes every day. Taxes seem to be going up all the time. So I'm putting off paying taxes now to pay them later, but that's an advantage to me somehow. So it's just, and I'm thinking back, and I'm sure my thought process back then was different. It was more like, just F you, I want all the money that I'm making to spend right now, because that's how I used to live my life. Fine, right? But I'm thinking to myself over the weekend, I'm like, how many people go through the same exact thing in their heads, or just think to themselves, like, this sounds crazy, but everyone around you in your hiring class is doing it. All the other employees are doing it. Everybody else is. So why not? Like, I might as well do it too. It seems to be the thing that everybody's doing, right? So I just, I was thinking back to that, and it's just crazy, like how we get in, and it's the broader picture too on what we're told to do when we're young. I mean, the big thing right now, of course, is student loan debt. There's billions of dollars in student loan. You can go bankrupt and completely like quit life, and you still owe your student loans. Like, there's no way to escape them. And these colleges are charging kids $50,000, $60,000, $80,000 a year to attend these colleges, to give them these degrees that are useless pieces of paper. But it's all these student loans. It's all backed by the government, and it's all subsidized, and it's all guaranteed, but you can never escape it. It's just crazy, the advice that we give young people to my opinion, set them up to fail. So sorry if I'm going on rants here this morning. I got my Santa hat on. I'm super stoked for the holidays, but this stuff just keeps going through my head as I'm thinking to myself, like, how this country's set up financially and why what we do is so important. Teaching you how to take control of your money, how to be able to take advantage of things like self-directed retirement accounts, privatized banks, like controlling your money, not giving it out to other people, saving money on taxes, not through things like this, but by starting a business, starting an LLC. Solomon, who's one of our tax advisors that teaches 1041 exchanges, says it best. He says there's two tax laws in this country, one for the informed and one for the uninformed, and both are legal. And it's 100% true in all aspects. So open your minds up to these things as we go into 2022 and beyond. And I really do truly believe that it'll make a huge difference in you and your family's financial lives into the future. And things like this, while I'm not completely shitting all over 401ks and similar, I just feel like there can be a lot better ways to control and invest your money and control your retirement as to that. But nonetheless, let's talk about it. All right, so here we go. So employer puts in, so this is how they work. An employer, quote unquote, matches whatever you're putting in up to a certain point in most 401k plans. If your employer does not offer a match, I would just go ahead and say, don't invest in a 401k. It just doesn't make sense. But if they match, let's say 6% is common, you have 12% of your money going into your retirement account each year. You're only putting 6% in. Fine. That makes sense to me. The tax thing, what it's, the reason employers do this is they're getting breaks. They're getting tax breaks. They're making this a benefit for you. So they have a reason to do it. I'm talking about you. Why are you doing this? So it kind of depends also what your retirement means to you. So for me, like, I don't plan on making less money in retirement. I plan on working less in retirement, but having my money working for me and creating more money than what I'm making right now actively working. Does that make sense? So my passive income is going to be greater than my income now. To me, that's retirement. When my passive income, meaning money that's coming in through private money lending, through real estate rents, through dividends, through whatever else that I have set up, my passive income through businesses, that passive income is greater than the income that I earn now through everything that we do. Okay. Whether that's commissions from the whole life policies that we do, whether that's commissions through different relationships that we have built up, through partnerships, whether that's money that I'm actively having to go out there and do in my real estate businesses and in other things that I have going on. That's all active. Like I actively am constantly working on this stuff right now. But when my passive income that I'm spending no time to do anymore exceeds that to a level in my lifestyles where I want it to be, that's retirement to me. Okay. But for a lot of people, what they're told is your working years right now, put the money into this 401k because it's pre-tax money. So pre-tax money, you're before you pay taxes, it's coming out of your paycheck. So if you're in a 35% tax bracket now, the whole idea of a 401k is at retirement age, let's say 62 years old, you're not working anymore. So your income is way down. Your earned income, your active income is way down. So what happens is your thought is when you're older in retirement, it doesn't take as much to live on, like your house is paid off or you don't have as many bills or whatever it is, right? It costs a lot less money to live on. This is the thought process that you're told. So in this part in life, you won't need as much income. So your tax bracket will be lower because your earned income is less. So maybe you're in a 20% tax bracket then. So the idea is to get the tax break now when you're making the most money in your life. And later on, when you're not making as much, pay taxes on the money then, and that way you're saving. So that's the thought process. But again, the problems with it is, first off, what are taxes doing all the time? They're going up. Second, if you really want to live a nice lifestyle in retirement, you don't want less money, you want more money. So let's find other tax strategies, maybe a way to save money on taxes. But I digress. All right. So that's what's going on with the 401ks. 457s, 403s, whatever the case might be. Now, the other good thing about a 401k, I was just looking at these limits. I told you guys we'd get into this. So in 2022, contribution limits for employees who participate in 401, 403, 457 in the federal thrift savings plan is increased to 20,500. So you can now get 20,500 a year into those types of plans. All right. So that's a decent amount, because if we look at an IRA over here, you're limited to $6,000. So if you are looking for some reason to take advantage of these tax benefits that an IRA plan provides, you can get a lot more into an employer-sponsored plan. Now, if you're an individual, if you own a business, what I would recommend is looking into what's called a solo K. So if you have like a single member LLC or something, you can open up what's called a solo K or a solo 401k. It's just another nickname. An NDK is another name for them. But basically, it's your company sponsoring the retirement account. And a lot of times you can make it where you can get 20,000 in, or even with solo Ks, you can even get them up to like $55,000, $60,000 if they're done properly. If they're set up properly. So there's a ways to get a lot more money into the employer sponsored plans and things you can do with them if you're going that route. Now, and so that limits to 20,500. Yeah, the IRAs remain at 6,000. All right, so there's other limits to these things. So when it comes to IRAs, a Roth IRA. And by the way, a Roth IRA, the difference in a traditional and a Roth, a traditional is like I was just talking about, it's pre-tax dollars, pay taxes later. A Roth IRA, you're paying the taxes now, and then all the growth and everything, you're never going to pay taxes on any of it. So you're paying the taxes now, you'll never pay taxes on any of the growth if you follow the rules of the plan. So a Roth is definitely the way to go, but the problem is there's a lot of limits on these things. So for 2022, the Roth contribution income phase out is, let's see, 129. $129,000 to $144,000. So if you make $129,000 to $144,000, you're able to put in less than the $6,000. Once you hit $144,000 and above your income, it's adjusted gross, but once your income's 144 above, you can no longer contribute to a Roth. So if you're making decent money, a Roth is not even an option. So as much as I actually like Roths, because of the fact that you can grow everything, you are giving up control. Roths have a 5-year plan where if the money's in for 5 years, you can take out some of the contributions without penalties, especially if it's used for certain things. So just double check with your accountant before you pull money out of these. But typically speaking, it's got to stay in there until 59 and a half years old. But if you're going to do a retirement account, I'm a much bigger fan of Roths because of that limit right there. You just have the contribution things. Now a strategy that we do a lot with these plans is what's called a Roth conversion. So let me just show you this. And this even could be a little backdoor if somebody wanted to get a Roth going, but they make too much money. So if you have, all right, so if you have a 401k, if it's from an old job, so you're not actively there anymore. If you have an active 401k, you probably can't do this until you leave the job, because when you're actively out at a job, that 401k is tied to that job and you're severely limited on what you're able to do with it. So you can't, for instance, take the money and move it over to a self-directed custodian. You can't take the money out and convert it to a Roth or an IRA or something like that. So you're limited on what you can do. The only thing you can do is take a loan from it, which we can talk about. But so one of the options, though, if it's an old 401k, so you're not actively at that job anymore, is you could take that thing and you can convert it. Convert it to Roth. So let's say you had $200,000 in your 401k and you make $200,000 a year. You have $200,000 in your old 401k and you make $200,000 a year. So again, you don't qualify for a new Roth. And even if you did, you can only put $6,000 a year into it. So it's going to take a while to build up a new Roth IRA to a point where you have any decent amount of money that you can actually invest and make some real money with it, right? But if I had $200,000 in there, I can take $200,000, invest in some businesses or some real estate, and I can make a ton of money. All right. So what I can do is, one of my options is I can convert this old 401k into a Roth. All right. Now I am going to pay 10% penalty. I take that back. I didn't need 10%. You are going to pay taxes. Okay, so you're going to pay taxes on this $200,000, but it's going to get it out of this traditional retirement scheme, and it's going to get it into a Roth retirement scheme. Meaning, instead of taking this $200,000 and growing it to $1 million, growing it to $1 million through smart investing, and then when I take that out, I'm paying taxes again if it's a traditional on the full $1 million. So the taxes due, let's say at 30% or 300,000. So I net 700K, right? So the 200,000 over here, if I pay taxes on that right now by converting it, let's say the same 30% tax. What's 30% of 200,000? 60 grand. So I'm paying taxes of 60 grand. So now I have So now I have 140K in there instead of the 200, but I can take this 140 and let's just say I grow it to 900,000. So I make 100,000 less because I'm starting with 60,000 less. I grow it to 900, but now when I take this 900 out, I don't pay taxes on any of it. So instead of netting 700, I'm netting 900 by taking that tax hit now, as opposed to later on when I'm pulling the income out. Now, again, there's a lot that can go into that, obviously. To be able to get those kind of gains, I would suggest what's called a self-directed. A self-directed retirement account. And that's what's going to allow you to not only invest in the stock market, but invest in everything else. So real estate, businesses, crypto, and everything that surrounds it. And are there some pretty good gains to be made in crypto right now, if you know what you're talking about? Absolutely, right? We are right now putting together an incredible package with Sponsor Montgomery, who's one of the leading crypto experts in the country right now. And we've teamed up with a self-directed crypto custodian, and we're putting together an entire crypto retirement account package right now for you, which will be really cool. We'll be coming out with that, if not by the end of the year, right at the beginning in January of 2022. So if you're looking into crypto and using that as a means to grow your wealth, it'll be a great little package for you to check out. And the reason I like these with crypto is because there's huge gains to be had in crypto, right? So if you are gonna, a lot of people say the strategy for Bitcoin and Ethereum is to buy it, dollar cost average in, and hold on to it. Hold, because it's very volatile. It's very up and down and huge swings, 20, 30, 40% swings up and down, monthly at times. So, if you're going to buy a dollar cost average in and you're planning on holding long-term, let's wait for Ethereum and Bitcoin to be adopted. And in 10 years from now, they could 10 times their value, 100 times their value, whatever the case is. If we're dollar cost averaging in for the long-term, who cares? But if we're expecting those kinds of returns, why would I not do that in one of these kinds of accounts, right? Why would I not do that in a Roth account? That all of that profit, if I have 100 grand in there, it grows to $1 million, 900,000 of that is now tax-free. So why would I not do that if my plan is to hold it long-term anyways? So love that strategy for you crypto investors that are the long-term, what do they call it? HODLing, right? H-O-D-L. So that's a great strategy right there. Heather, for the Roth I was talking about was for an individual. If you're married or filing jointly, it's 204 to 214,000. So 204 to 214 for a married couple filing jointly. I'm just taking a look at these other changes. Let me just pull this up. All right. So Cindy was asking, I don't have any issue spending my etc., but you'll have to pry my bit from my cold day. Yeah, Cindy. So why not have that Bitcoin in a retirement account where when you do want to cash in on it, it's all tax free coming out? Claudia said, can one convert at any time? My husband is retired and self-employed. Yeah, you should be able to, Claudia. You should be able to do a conversion on that. And they're talking about, and with our new crypto self-directed account that we have coming out, it does include free conversions as well. So we don't charge anything extra to do that conversion. So just pay Cleanser. We'll have more on the process for getting those started here very soon. Yeah, it is difficult with a smaller account, Cindy, you're right. And that's why things like conversions, or if you have an old 401k, let's move that over. If you have multiple, like I talk to people all the time that are like, I have 3 or 4 401ks from old jobs just floating out there. Well, let's get those all into one account, and it gives us more investing power to do what we want to do. And then just to hit on a couple of the other types of accounts that are out there. I mean, there's HSAs, which are health savings accounts. There's SEPs, simplified employee pensions. There's simple IRA plans. So there's all different types of retirement account plans as well. There's what's the college one? 529 plans that are designed for tax savings for college students, or for parents that are investing for their kids' college education. Those are all tax benefited tax qualified accounts, so to say, not necessarily geared for retirement, but different things that you can do. But all of those you can do self-directed accounts with as well. So it's one of those things where if you're doing anything in a tax qualified account, you might want to look at self-directing that money and controlling the money on your own. All right. So I was just looking at the IRS website to see if there's any other changes in 2022. Yeah, so I'm not really seeing anything. All right. Does anybody have any questions on retirement accounts or strategies? And there is talk of getting rid of that Roth IRA conversion. I don't think it's been passed. I don't think it's actually in one of the bills that's been passed, but it's been floated around out there in a lot of these bills that are going around being proposed. So just keep that in mind. If you have these accounts and you're looking to convert them, do it now, like sooner than later, because again, if someone can pay $60,000 in taxes now, as opposed to $300,000 in taxes later, do you think the government's going to let that happen for long? No, they're going to want to shut that down. So do it while you can. All right, Ethan's about to make his first investment using his self-directed IRA. All right, that's awesome. All right. So that's what I wanted to talk about a little bit today. I mean, we could get into more with these self-directed retirement accounts. And just so you guys know, everything that I'm talking about with IRA, SEP simples, 401k, solo Ks, all this stuff. Remember, the only difference in one of these accounts at Fidelity or Morgan Stanley or TD Ameritrade or Schwab or wherever you might have an IRA or retirement account, the only difference in that and a account at Horizon Trust or Equity Trust or New View or one of these other self-directed custodians is what they allow you to invest your money in. The contribution limits, the rules, the regulations, it's all exactly the same. There's no difference between a retirement, an IRA at Fidelity and an IRA at Horizon Trust in the eyes of the IRS and the government. There's no difference. They're exactly the same. So the only difference is what those companies allow you to invest in. And if you think you have a self-directed IRA at Fidelity, because they'll sell you a self-directed IRA at Fidelity, but guess what? Call them up or try and invest in the house across the street from you that you want to rent out, or call them and tell them you want to buy, you want to invest in Intellivision, which is a private company that we were talking about, a few months ago, or something like that, a private fund like Safari Fund. They don't let you. They let you pick stocks. They let you pick bonds, funds, ETFs, things like that. But you're not actually controlling and being able to invest in anything that you want to. That's what a self-directed and SD IRA is and does for you. Crypto too. Fidelity, they're starting to come out with some of these ETFs and some of these index funds that track crypto, but you're not buying the actual crypto. Gold, same thing. You can buy, indexes that track gold or silver, or precious metals, but you can't actually physically buy the gold like you can with a self-directed. So those are the biggest differences. So you need to go with like a Horizon if you truly want to be able to control and self-direct that money. But other than that, there's no differences in any of it. So Ethan was asking, are there online marketplaces for buying shares in private companies? So Ethan, if you're what's called an accredited investor, there are definitely places you can go to find these offerings. It really boils down to how the investment is registered with the SEC. So there's what's called a Reg D fund. There's what's called a Reg A fund. So there's different types of funds and how they're registered with the SEC. And that's what governs how the funds are allowed to be marketed to the public. So when we talk about like Safari Fund, for example, the fund that Chris is, a partner in, that's funding a lot of the purchases for the mobile home parks that Chris Root is doing. those are friends and what are called friends and family regulated funds. So we are not allowed to just advertise that fund, for example, on Facebook like on Facebook. So we can't just run an ad. Hey, come invest in this to invest in mobile home parks. You're going to make 7 to 12% returns. Check it out. Like we aren't allowed to do that. It's completely illegal. But if we have a network, an inner network, like we do with MSTV, for instance, or the Private Money Club, we can talk about it with our network on there because that's a membership and you guys are considered friends and family at that point. So we're able to do that because of that. So it depends on the type. I mean, I know there's different, there's things like fund. What is it? Fundwise, I think it is. I was looking at this the other day. Fundwise, is that it? Fundwise Capital. There's a bunch of different things out there right now too that are raising money for deals. Like Grant Cardone just raised money. I think you got to be an accredited investor for it as well, but you hear about it from word of mouth and stuff like that. So, there are marketplaces out there. Something else you can invest in are businesses, startups. I mean, that's whole nother world when you start looking at those kinds of things. Now get educated. That's a whole different world. But yeah, when you start looking at IP, intellectual property, and some of these startups, I mean, this is all stuff you can do with a self-directed IRA. If you're educated and want to go at it. So, and yeah, we could talk. I can get into the difference in Reg A, Reg D funds. What to look for when you're looking at private funds. Actually, that would be a great training. Let me I'll make a note of that right now. And when we get back on the new year, I will definitely spend a week and we'll talk about different types of funds. Actually, I can bring a guy on. This guy raises hundreds of millions of dollars. I'll bring him on to talk about funds with us. Write it down now so I don't forget. All right, so I have a couple questions. Can you roll half of the 401k to a self-directed Roth this year and half? Yeah, David, you can definitely so if you have an old 401k, you could definitely convert half to a Roth and the other leave it traditional, or you can, take half and put it to Fidelity and the other half into a self-directed account, or you can split it up. Absolutely. Yes. And if you're looking at the tax obligation part of it, yeah, it can definitely make sense to, spread out over several years how that money's being converted or withdrawn or whatever the case might be for that tax burden. So yes. So in that case, you would want to talk to, if you're going to convert it over with like Horizon, talk with Brandy about the best strategy, and then work with your accountant or somebody like Corporate Capital with Brent Carlson, and they can help plan that out with you as well. Okay, so Cindy's saying that Grant Cardone had ended up being a REIT that he did. So that's a little bit different. REITs are more publicly traded. They just have a lot of fees, and I'm not a big fan of REITs. All right, but I will bring somebody on as soon as we get back from the new year, and we'll talk all about private funds, what to look for, how they work, and we'll get into some of that stuff. All right. So when it comes to 401ks, the last thing I wanted to mention on these is because I keep getting this question all the time is, should I continue to contribute to it right now? So I'll go back to saying, if you're putting in and you're getting the match, fine. It can make sense. I mean, even if the stock market drops in half and your money's invested and you don't get it moving into cash into something very conservative like bonds quick enough and it drops some, if you're getting matched, 100% of what you're putting in, then, makes sense, right? Even if it comes down some, that was still money that was growing that you're being given. So to me, that makes sense, but definitely look at backing off if you're putting in more, or maybe pausing even for a while until we start to figure out what's going on with this bubble. So, there's no right or wrong answer for this stuff. It depends too, how close are you to retirement age? But if you are stopping contributing to a 401k or pulling one way back, don't go blow that money. Maybe look at redirecting that into a new money multiplier policy, a new infinite banking policy, but keep that money moving. Don't just go blow it just because you're not putting it into retirement that way. Definitely put it somewhere else, continue to invest and grow your wealth. And that's going to be your best bet. Or maybe even look at, moving away from a 401k, but if you want to take advantage of that type of retirement account, maybe putting that money into into your solo K. All of you should have LLCs by now for the tax tax benefits alone, if not for starting to learn business and getting a second income. I mean, I think everyone should have some kind of side hustle going, some kind of way of not only educating yourself, but also actively creating additional income streams, whether that's learning passive lending and lending it out that way, whether that's some kind of home-based business or some kind of business that you can run from home. I think everybody should have that going, and everybody should have a company set up, and everybody should be taking advantage of these tax laws that are out there to keep more of your hard-earned money. And because it's not always about how much money you make or how much money you save, it's how much money you keep. You hear us say that all the time to crypto investors, especially, that are like, I'm making all this money. It's like, all right, great, but keep it. Show me you made all that money when it crashes. Like, let's see if you actually kept it all. Saving, same things. If you're saving, but you're saving under a mattress, or you're saving at a bank in a savings account, you're losing money because of inflation and everything, right? So try and keep that money that you're saving. One of the reasons why we love the money multiplier and the whole life policies is because you're able to save, but you're also able to spend and invest at the exact same time. And it's in there growing, keeping up at least with inflation right now. So those are all things that we want to look at when we're looking at, keeping money moving and being able to continue to grow wealth for the future. So Claudia, solo K is just so if I have an LLC or an S corporation or some kind of company set up and it's just me, or it's me and my wife, we qualify for what's called a solo K, or an individual K. And it basically has the same rules as a 401k, how the contributions work with the taxes and everything like that, has the higher limits, the 20,000 that you can put in annually. But it's your company. So it's called a solo K. A 401k has a lot more administrative costs and things like that involved, because there's rules on how the employees are treated, and then how each employee has to be treated the same. With a solo K, it's just you, so there's less rules and regulations and fees involved as well. So you get the benefits of a 401k, but on a smaller level with just you, or you and your spouse. And you could open up self-directed ones. So if you are looking to dump a bunch of money in for some reason, maybe it is for a tax benefit right now, there is still reasons to do that. Don't get me wrong. A solo K could be a good reason to do that right now. All right, what else on retirement accounts? I'm just trying to see if I had anything else written down. All right, well, I think that's all I have for today then, guys. If we don't have any other questions on retirement accounts or anything like that, we'll definitely, like I said, we got a lot planned for 2022. So just wanted to kind of end this year on a fun little note here with my Santa hat on. Be prepared for 2022. There are a lot of changes coming, and there's a lot that's going to be happening in the markets. So just be prepared, be ready. Start thinking about, hey, look at the charts. I mean, you don't need us to tell you. We've been in for the last, since 2008, 2009, when the recovery happened, we've been in one of the biggest bull market runs in the history of the country. It's been going and going and going. The Fed continues to pump money in. They're talking about tapering, raising rates. We've had zero rates for so long. So this thing's been booming and booming and booming and booming. Most people say due to all of the artificial pumping of the Fed and everything else that's happened over the last decade. But history tells us that cannot happen forever. And we will see a large pullback, if not large downfall, and probably bear market to come. So when we look at what we've seen over the last decade now, how much higher can it go relative to how far can it drop? And if you're of the mindset like I am, that we're at somewhere near the top, maybe we go a little bit higher, but we can potentially see drops like this, maybe it's time to start cashing out, getting out of there, moving our money into cash or safe positions that are ready to deploy when things do come down. So we're ready to rock and roll. Make that decision, but one way or another, pick a strategy, be ready. We'll keep talking about it. We'll keep educating what we're hearing. We'll keep bringing economists on, and other professionals and experts to get you guys going. So thanks so much for being here. Happy New Year's. We'll see you guys Wednesday. We are doing Wednesday this week. Like I said, no Money Club Mondays next week. But we'll start back up January 3rd and be ready to rock and roll 2022. So Merry Christmas, Happy New Year's. We'll see you guys soon. Thanks so much.